back, everyone. I think this is going to be a good one. I'm really excited about today. I spent a lot of time in work. I don't like to work too much, so spent quite a bit of time here um, listening to some good podcasts this week, and I'm ready to talk about them. And Twitter was on fire. I know that there was some conversations and tweets I really enjoyed uh, going on with Richard and Alp, especially. So maybe they could explain to all of us what they were, some of those points in their tweets. But I really enjoyed listening to this the Tim and Andrew uh, wrestling match on Top Traders Unplugged. I mean, I listened to this thing like last Saturday or Sunday, and I was listening like early in the morning. So I just could not get enough of this thing. And like when it was over, it was like 9:30 in the morning here. And I'm like, I mean, what am I gonna do for the rest of the day? My day is like over. The highlight of the day is over. It's nothing is gonna top this. And then uh, I don't like to tweet, comments or parts of podcast until I can get a good transcript. And 99% of the time, I get the transcript a few days later after it comes out. It comes out usually delayed on YouTube. So go to YouTube. I like to do the clips thing where you can just hear that part of what I tweeted and get right into the meat of it. I'm really trying to help you guys out, enjoy life as much as I do. So, um, but that was this best line ever. I mean, I've got like 8 pages of notes that I've been taking to discuss this. And I'm not going to go through it all because it may not even be interesting to anybody but me. So I don't want to bore you with this debate on replication and it's this free for all uh, Jerry Springer show. That's what it reminded me of. But there was this one quote from Andrew that right in the middle of it, I had to say, stop, tweet this quote, and then just move on because it was so good. It's the best line of the year so far. And that was, I highly recommend you don't invest in my fund. We clearly ran over your dog. I mean, come on. How good is that? Andrew is so good. He's so smart. Breath of fresh air. He's funny. Um, and so that's why he, in good performance. And they know what they're doing. Not perfect. It has, some issues maybe, but and then it has a million issues in the future. Oh yeah, this is what's going to happen in the future because it's not perfect or whatever. Replication's not great. However, historically, so far it's done pretty well. It's nothing to complain about really. Um, I thought Tim had some good points. He went for quality. He went for quantity over quality. He had a couple of high value targets, and he could have hammered on him some more. I would have like gone for the jugular on some of his, but he went a broad range of complaints. Or yeah, he was his own worst enemy sometimes on that. So whatever, I'm not going to help him. But Andrew, he left out, I think, his most important point that look, these are the top CTAs in the industry. There's the 20 biggest, the 20 top, all the institutions probably are investing in them, or when they invest in CTAs, that's mostly where they're going. A subset of these guys possibly. I don't know how many people actually own the SocGen 20. It's not a bad replication of managed futures, whatever. Okay, so, but ETF investors have no alternative. What are they going to do? And the fund went from 60 million to $1 billion last year, over $1 billion. So, it was had good performance. It was somewhat popular. And so I think it's going to, do just fine in the future. It's a good standard bearer for what managed futures is. And Andrew's a great marketing guy and spokesman and funny and smart. And so he knows, he's doing it differently. And his results are different. Who else has gone from 60 million to over $1 billion in CTA land? All right. All right. Hopefully you've listened to that thing and you can make some comments and just general comments about replication in general, DBMF in particular. All right, you ready, Oleg, to get us going?
Hi, everyone. Hi, Jerry. Hi, Mike. Hi, Richard. Hi, Brian, Bruno. Hi, I have seen Jerry Smith here. So I'm very glad to see all of you and all other people who are involved in our discussions. It's very precise to my heart to be here, always. So I'm now in the beautiful forest. I was swimming in the sea today, so very nice day. And just now I get remembered when Jerry said about the podcast. As you all know, almost every day, I listen Top Traders Unplugged, and my favorite, of course, I listen Systematic Investor Series, and my favorite, of course, topic is trend following, classical trend following. And I get remembered how I was listening maybe 2.5 years ago. I was listening episode maybe 58 or 59. And Jerry was speaking about stops, and I remember how I listened it maybe only 2 or 3 minutes about exits. He was talking about exits, and I thought how incredible, wonderful it is, and I must think about this new and that moment information for me. And it was not an hour as usual. It was only 2 or 3 minutes I was listening. And after that, I began to do a back test. I was very impressed. I remember this moment. It was maybe in December 2020. And I remember how I was impressed that we must have one exit. We must have one exit and not move it too fast. Because I was from short-term space, and so I traded for many years in short-term space before. So, and I get now that better decision is not to move our stop and to wait our breakout. So it was wonderful, and I remember this. So I'm very happy to be here as always, and I'm sure that always I will be happy to be involved in this our trading ideology discussion.
Thanks, Oleg. Good morning, Richard.
Good morning, Jerry. Yeah, good morning, Oleg. Good morning, everyone. Well, it's good evening for me over here, but yeah, Jerry, I love that podcast between Tim and Andrew, and I know sort of Andrew came away thinking that Tim was hammering him, but I was thinking back to some of our spaces that we've had where, the debate gets quite vigorous, and I think maybe Andrew should be joining us more on these spaces to sort of get the rhythm going in relation to active debate. But it was a good podcast. I thought both of them made very good points. I must admit, I did like some of the questions that Tim was asking Andrew. There were some of the concerns that I have in relation to the replication method that Andrew is using. But I think Andrew, held himself very well. It was interesting. There a little debate about the definition of alpha, where Andrew was saying that. Definitely fee reduction is part of alpha, and Tim was saying clearly it's not, but there was an interesting debate. And then, some of the things I was interested not only about the debate between Tim and Andrew, but I'm also quite interested in Corey Hofstein's ETF, which he's just launched, which is also going down the track of replication, but it's using a slightly different process to Andrew's. It's using Andrew's approach for what Corey calls his top-down approach, which is using the basis of regression and replication of an ETF to identify what particular markets are being traded by the group represented in the ETF they're trying to benchmark against, but also he uses a bottom-up approach, which seems to be resolving some of the issues that we might have had with Andrew in relation to the lag of the approach that he's adopting. So the bottom-up approach is looking at integrating trend-following systems into the replication process. So the nature of the systems themselves, using a bottom-up approach and this top-down approach using the market selection through regression. It's an interesting approach by Corey. Maybe that's going to sort of fix some of the possible issues associated with trading the lags of Andrew's ETF, but a very interesting debate, Jerry.
Yeah, I agree. I want to get Moritz's view on this issue if he has one after just in a second. But I think I understand Corey's approach. I listened to a podcast where I think they were talking about it. So I think the one thing to keep in mind, I think Tim and other people, they kind of forget that, Andrew has a bottom line, and that is replicate the index. That's just it. And so the index is doing its thing, and Andrew just doesn't want to get too far off that. So what Corey is essentially doing is sort of stepping out of that entirely. If you add in the systems like he's doing to the replications, great. It's going to you could argue that it's going to be a better product than the SocGen CTA and DBMF, but it's just not the same. And he's out into maybe the trend following world with a better performing fund that really doesn't have the SocGen CTA index tied to it. So that's fine. It's just not what Andrew specifically is trying to do. It's like the S&P fund. It's going to be its success is judged by how close did it mimic the S&P 500. And then if someone else comes along and says, "Well, I'm going to create a fund. It's going to be half S&P and half discretionary trading, or my strategy, systematic strategy of trading." Hey, that's fun. You're just not in the index business. You're in the alpha generating business to some degree. And you may be the best fund out there. It's just two different camps. And I don't need. He doesn't need me to tell him that. It will improve. It could have better performance, but it won't improve what Andrew's doing, except performance wise. But his ultimate issue is not performance; it's replicating the index. What say you, Moritz?
Hey, good morning, good afternoon, or good evening, Richard. I missed the first 8 or 9 minutes, so I'm not sure what you've covered, but I listened to a Corey Hofstein podcast yesterday on a train with Mep Faber, and he was explaining his return stacking again, and he spoke a little bit about that ETF that's coming up. So I think they have a 60-40 portfolio, and they're using futures because that's capital efficient, and then their return stack managed futures, they call it managed futures on top of it. So that in and by itself, sounds like probably something that's a good idea. But I agree with you. I think Andrew wants to match the index, and there's investors out there that like that, or they would prefer that because the index is out there. That's their benchmark. That's something that they can have a look at. So how can you best match and track the SocGen CTA index? You could invest in the underlying funds, but that doesn't work for an ETF. Or you need to do, I think, a top-down replication attempt, which is what Andrew is doing, where you use certain techniques, regressions being one of them, to get as close as possible to that index. It's one way of doing it. Maybe it's not perfect, but it is one way of doing it. I can't really complain about that. And then the other way to do that would be to go bottom up, and that is you combine several rules-based trading strategies, a 100-day breakout, a 200-day breakout, moving averages, whatever. You create this ensemble, this portfolio of trend strategies, and you hope that this basket of strategies will have a high correlation to the SocGen CTA index over time, but you just never know how stable that's going to be. None of them are perfect. I think forget about perfect. you cannot, without investing in the underlying funds of the stock chain index, you cannot perfectly track it. That I think that's a fact. And I think Andrew is quite clear about this. But what I like about Andrew is that he's not hiding, trying to hide putting sand into anybody's eyes and going like, oh, I will definitely do this and this will work and it's the best thing out there. He doesn't do that. He is very open about the possible shortcomings. I loved it when he said that somebody ran over his dog and they shouldn't invest in his fund. But look, time will tell. We'll see what works best, and if these products get any traction. I think Corey's product could get some traction. He's good with the marketing. It's going to be interesting.
Yeah, what is great is that we're getting a large number of ETFs now, sort of starting to approach the managed futures sort of structure, which is great. So certainly, in the last few years, we've seen this sort of growth of ETFs looking in our realm. And Jerry, with yours coming up soon, I think that's great for industry. Certainly good for retail investors trying to get exposure into some of these methods, which has been traditionally very hard to do.
Yeah, I think it's a good idea. They were saying they want me to come on, and I think at least someone said, "Come on, and let's bring Jerry on next time to talk about this debate." I mean, I think the debate was kind of fun between, basically is DBMF harming managed futures? I don't think it is. I don't think there's much left to that debate. We can't improve upon the original, but I'll have my opportunities to talk about ETFs and trend following, and managed futures. So I'm looking forward to being able to do that in the future. I think one of the things that really stood out, and this is where Tim really had a huge advantage, because I don't think that it's a problem to talk about what might occur in the future. But, it's what might occur in the future, what makes us nervous in the future about any sort of investment, and what has happened in the past is two different things. And so, but one of the things that I remember thinking after a big discussion here on Spaces, I sort of changed my mind all of a sudden. And I sort of realized that, I think it is an issue that he only trades 14 markets in the future. I know the regression, I know history of the actual performance, but in the future, it could be like a problem, because I'm like the opposite. How can I argue for small bets and 300 markets? And even though managed futures CTAs minimize outliers to where they're easier to replicate because you don't have any sort of big trade allowed to turn into a big outlier like classic trend following would allow it, because they scale it back to make it look more like the sector. But still, on some bad periods, and then all of a sudden we have March, that could, in different ways, come up and bite you. And so on the podcast, Andrew admitted that, which I don't know why I admitted it, or made it known, because I don't know if it was worthwhile. But he did say that during the period of March, that everybody was getting killed in those short interest rate futures, that some of the CTAs quit reporting their returns. And so he's relying upon these returns, and now they're not reporting the returns. Now, Tim jumped on that, but I would have spent the rest of the podcast on that, right? Because that's the ultimate issue, the lag and the lack of the amount. He doesn't trade as many markets as the 20 CTAs do, or anywhere close. And so maybe that would be one of the improvements in the future, to add a few more markets, rather than crude and gold representing commodities, maybe a couple more, right? Of course. So now Andrew did not specifically specify whether, I don't think, I listened to it more than once, whether his returns were impacted by this lack of reporting. Now, I don't, because I think he updates his returns on Wednesday. So did they go over a Wednesday and not update the positions? He doesn't really say. But anyways, you could see how that could be, and actually probably was, an issue of you're relying upon these guys to report, and then they, for good reasons or whatever reasons, they don't report. And of course, that's their ultimate edge. Lobby SocGen to change the way that this thing is updated and reported, and then screw with Andrew's business, I guess. I don't know. But did anybody else pick up on that?
I didn't specifically hear about that impact that you're talking about. I did remember Andrew bringing it up in that they didn't report over that period. But I also noted that Andrew was talking about during periods of general underperformance of the CTA index, of course, their lower fees means that they tend to outperform over those times. But during other times when we get significant price moves and the CTAs are moving very strongly, he was suggesting, especially over the last 6 months or so, they have tended to be underperforming. So, I know there's swings and roundabouts, and fee reduction is a big sort of impact on the overall returns they're generating, but it's still very early days for Andrew. It's very hard, I'd say, very hard to, gauge how they're going to perform over the long term, in my opinion.
Yeah, I thought that his fee reduction alpha was kind of nonsense. I think the whole conversation was not worth very much. But I think everyone kind of knows that defining alpha is kind of hard. Everybody probably has different opinions on defining alpha, and Andrew came up with this little quote that's just kind of funny, and it's kind of interesting that fee reduction is the purest form of alpha. Who takes this seriously besides Tim? Come on. It's not, is it alpha? I don't know. It's unlocking more alpha. You want to be a wordsmith and semantics, and then, oh God. And then saying that if you don't stop saying this, you're going to get a tap on the shoulder from the SEC. Oh my God. Where's the referee? Where's Niels? These guys are duking it out. I think Niels is just on the sideline. I would have loved smiling, and I would have loved to seen this on video, just watching. God, it's been so much fun to watch the reactions, the eye rolling. But I don't know if I asked ChatGPT, what is alpha? And then it told me. And then I asked it, is fee reduction alpha? And it said, no, it's not. But no one took it seriously anyways.
Yeah, I actually the first 20 minutes of that conversation I found interesting, and then they had about 40 minutes where they didn't like each other a lot anymore, and it became more like a contest of who's winning the verbal fight, and that I didn't get much out of this. And like you said, I would have liked it to watch it on YouTube, the video, but it felt like they didn't like each other much more. So this remains an open debate. But as far as the alpha is concerned, to me, fee reduction is not alpha. Alpha is the excess return that cannot be explained by really anything other than skill. And skill is, could be quantitative, systematic, could be a discretionary trader, but it is something that's unique, something that you do that milks out an extra basis point from these competitive markets. And reducing fees is not unique. That is not a skill. That is not something that only you can do. That is something that everybody can really do. It is, of course, great for the end investor. Lower fees means, everything else being equal, greater returns for the end investor. So yes, that helps, but I wouldn't really put it in the alpha bucket. I don't think Andrew is going to be called by the SEC. Well, I'm not sure. Well, Gary Gensler seems to be very busy with cryptos these days, so probably he's not going to be calling Andrew on calling fee reduction a source of alpha. But we all understood what he meant, right? He's out there in the market competing with a product that is fee efficient or lower fee than most other investment options out there in the space, and he's trying to track an index in an ETF format. ETFs is the wrapper that's loved. ETFs are great from a tax perspective, and people who don't want to take the deeper dive and they only want to look at the benchmark, which is the CTA index by SocGen, that's a fit. It doesn't mean that it's going to be the best trend following product on the planet in the future. I would have my doubts. Well, I don't think it will be the best product out there, but he's finding his niche, and kudos to him. Let him do that. If he can raise money and get more people to invest in trend-based return streams, that's good. That should lead to an improvement, and so I don't have an issue with that at all. I just found it a little bit silly at the end that these two guys were really butting heads like my two sons would at age 12 and 14.
I was thinking it reminds me of Spaces, some of the earlier debates we used to have in these sessions in Clubhouse.
Oh, I love these. I love it that they did all that. I think it was so much fun. It was so much passion. And yeah, I mean, that's the highest rated show Niels has ever had. I mean, I think Tim needs to understand how to pronounce Niels' name next time. It's not Niles.
Niles.
I mean, you could tell I really listened to this thing closely. I think another thing that Tim, I thought he was getting into, but not sure, was the lack of risk control or risk management. And I'm not an expert on this, but I understand replication enough to know that you can't add a layer of risk management to a replication strategy that's trying to replicate an index. The trades, the markets, the strategy, the longs and the shorts, everything about these 20 CTAs is combined into the returns that they give each day and week and month, and he's using those returns to replicate those returns. And if there's money management inside of those CTAs, he's picking it up in the same way that he's picking up the markets and the entries and the exits. And okay, so there is a problem with concentration risk, let's say, 14 markets versus, they're each probably trading 100 or more. And, but you can know more put on top of that DBMF index replication, a cutback strategy when you lose money, or a cutback strategy when you underperform, any more than someone coming out with an S&P index fund that says, we're going to track the S&P, but you won't have the 50+% drawdowns. Well, then you're not going to be tracking it. And because here recently, being the last 5 or 10 years, every time the S&P crashes and gets into a situation that any CTA would say, whoa, let's start instituting some of our risk management, it's a V bottom and it rallies right back to the high. So you're stuck with what Andrew does. Now, and you're stuck with what the index does. And this is Andrew's job to replicate that. He usually beats it by the amount of some of the fees. Here recently, he hasn't. So there's not a lot you can do about that except not invest. And roll the dice, you're essentially saying, hey, I don't have access to these CTAs anyways. I'm an ETF investor. It's the industry's top 20 funds. And really, you'll probably be right, given that, to assume that it is going to be the best performing. Parentheses, I agree with Moritz, but it probably won't be. And I'll roll the dice and say, hey, I'm starting out ahead 2 or 3 or 4%. I like that edge. in at least matching their performance. And then maybe some institutions will say, damn right, I'm right there with you. I like that 4% edge starting on Jan 1 too.
Yeah, I tend to think that the risk management is one of the weak spots of Andrew's. So the CTAs he's benchmarking against, the index, I think the comment Tim was making was valid in that, a diversified systematic trend following CTA, one of their prime considerations is risk management. But really, with Andrew's models that he's applying, there's systematic risk associated with the replication process, and there's systematic risk associated with the lags that we've talked about and things. So, and I know, in discussions we've had with Andrew, where we've questioned about the use of stops and things like that, where he's sort of saying he doesn't apply these principles. I tend to think that that's, there is a few loose holes there in terms of risk management. What do you think?
No, not on the last part about stops. The stops, the entries, the exits, the markets, he incorporates all those. Andrew is effectively not using stops if those CTAs are not using stops. If they are using stops, his positions reflect that. He's netting out.
His positions are reflecting it, but he's doing it through replication. So he's doing it through replication against the concentrated market, and saying, all right, let's get representation of all of these CTAs in this index via these concentrated markets I'm preferring to deal with. And so he's doing his regression analysis against their performance. That there's no risk mitigation mechanisms built into the replication process. That's my concern in this lag. So, the March issue, I think, is something where we saw the CTAs plummet. We noticed Andrew was concerned about that impact on his returns when we had the bond hiccup in March. And then he'd also said, as you say, Jerry, that they weren't reporting at that particular point. There's systematic risk there, potentially. So, yeah, I just see that there's certainly sort of weaknesses in the replication process in dealing with risk associated with the replication process. I'm not saying, that they certainly are mimicking the performance of the CTA. So that implicitly implies that if the stops are being used by the CTAs, it's going to be represented by performance. But this is where I'm saying the replication process it's not necessarily causally correlated to it.
Right. I think that lag is the major problem. I think can be, sometimes if you lag, you don't get whipsawed. It works both ways. I would assume that it's only reasonable to assume that it will be worse though, but it won't always be worse. And then we're all kind of a little bummed out by the concentration. Andrew could show us, his PhDs could show us that in fact, 14 is the perfect number. Adding more does not improve, and yet that's the back test. And so he'll be talking to me as a person who's very skeptical of all back tests and saying, oh, I get it. You don't need to add in soybeans, or you don't need to add in copper. Historically, what does it do if you do? It doesn't really do much. Well, add it anyways, because it may do much in the future. We just don't know. And so that's my default is, using a stop loss in my system doesn't improve performance. It's a break even. So I use it anyways because that's in the past. All hell could break loose in the future, and I might really need some stop losses. It's a break even. It's not going to hurt performance. I'll go ahead and add it even though I don't really need it. So I think he should look at things like that as well. But I like my analogy, which is ultimately, he should not be adding any sort of extra type of trading on top of his replication, because that's not what people do when they replicate or when they create S&P index funds. People have to suck it up. His only issue really is underperforming the index, which historically he hasn't done. He's overperformed it. He's in any sort of replication is going to underperform at different points in times and overperform. I think he overperformed last year. However, the magnitude of underperformance is a bummer. I did like his comment, though. It was kind of interesting that you could have replicated March with just the 2-year note. And I thought that was kind of interesting. Probably not very profound because, so what? There's no way to predict that. But I guess that was one of his pushbacks on not having enough markets. But actually, in this particular situation, you could identify one market. No surprise, because that was what was moving the markets, was those interest rates.
Hey, hi everyone. Glad to be here. Can you guys hear me?
Yes.
Good. Well, I'm getting late here in the talk. I'm trying to get some points while you guys are talking about it, but actually it's so interesting to hear your takes. But in this thing about risk mitigation, wouldn't you say that it's well, from where I see it, it's as if he has some windows in which he can look where the CTAs are, and then he can replicate them and follow them. But there is a risk there that while he's between windows, he can go one way and the CTAs go the other way. So his main objective is to track them perfectly. Yeah, I get it. And if they are performing badly, it's okay if he is performing badly as well. But what about the risk that just after one window where he looked where they are, they go left and he goes right? Shouldn't there be some risk mitigation mechanism there to prevent that from happening? And yeah, what you guys think about it?
Well, just to clarify, I think maybe I misunderstood, but he's not going to go left and they're going to go right. He's going to stay left and they're going to go right. Is that correct?
Yeah. Anyway, my question is, between windows, the CTAs do one thing and he does other. He can stay where he is and they go anywhere, or he can go to a different direction.
I mean, this is the nature of the lag, and it historically in his back test, he was benefiting. The strategy benefited from having 20 managers who you were doing a lot of netting. So even the ones who moved very quickly, it was 1 out of 20, and they could be offsetting each other as well. One go left, one go right. Andrew sees no change. And then he also benefits from their size. I've already mentioned that he benefits from them cutting outliers short. But they benefit from their size and that their look back period is very long. So they trade multiple systems. So there is a likelihood that as the interest rates move a bit, they're not getting out on the first couple of days, and they're getting out in stages. Now, one of the things that happened in April, was all of the funds that the bigger managers, or let's say the managers, the CTAs that lost the most in March, made the most in April. So they did not get out of all of those things. It wasn't like they got out. Andrew had a lag. He didn't get the numbers reported. One of his responses in the podcast was, we saw no change. We were not getting update, and we were like, oh, they're unchanged on the day. They're not making or losing any money really. And so he said, oh, they must have preemptively liquidated. No, he later found out they weren't reporting. Okay, it's kind of scary. Hammer that, Tim. Get off the crap about putting food on your table. Come on. But, he went for quantity over that quality, and that's a big point. And so, Andrew, okay, comment on that.
Yeah. So I think the assumption here is that the time between windows where Andrew can look at the CTAs is close enough to be faster than the moves that the CTAs can do. It reminds me of that. I make an analogy here with digital sound versus analog sound. When you're listening to a I don't know actually how to say this in English, but here in Brazil we say long play. Those big black discs from old. When you listen to one of that, the sound comes from a continuous wave, and when you transform that to a digital signal from a CD, for example, you're taking samples from that continuous wave and saying, okay, between millisecond 1 and millisecond 2, or even a shorter window, you have this average sound. So this is what the digital will record, and you're actually picking shorter and shorter windows to get a wave that resembles the continuous wave, but it's never gets there. But the thing is, for the human hearing, it's okay to have this sampled sound, this mini samples that are never continuous, but they're for the human hearing, it sounds as if it is continuous, but it's not. So what I'm getting is Andrew does something similar to that, and from our perspective, and especially because those CTAs move in a quote unquote slow motion, he can do that weekly, and he is okay picking these weekly windows. But here is what I think is a risk there. If for whatever reason they get more, they get quicker, then this is a risk for Andrew. Don't you agree?
I certainly do, Bruno. Totally agree with you.
Oh yeah, I agree, and I think that it would be choosing my words carefully here, but I think it would be a very strong approach. I love the podcast, okay, but podcasts and spaces, they have a certain amount of worth. They're fun, and I enjoy them. Then I get back to real work. Okay, so I think there are some ways to protect your business and to protect yourself. If this is such an irritating thing and it's so bad for managed futures, then do something about it, real world, and protect yourself and protect clients, and just don't sit back and go on a podcast. So if this is really a plague on the industry, red flags, and there's a lot of buzzwords that he kept repeating, which I thought was really funny, because I do that too, just keep repeating the same buzzword all the time. So I think, do something about it, change your reporting. Where was SocGen? Why don't they have a fund? Why don't they have an ETF? Why don't these put together all these managers or something? I mean, why not make something available? I think they are scrambling to do something now, but it's like a battle back and forth. You make a move, they'll make a move, and then Andrew will make another move possibly. But yeah, these are risks. And once again, this is all that's available for ETF investors. They come in with a pretty significant edge. And maybe the ultimate winner in this whole game might be Corey, for instance. Like someone will say, okay, it's not really possible to replicate safely, and maybe Corey will win. Maybe other people's ETFs will win.
I have a feeling at least Corey's approach is explicitly embedding trend following systems into his model. And when I was listening to the Meb Faber podcast, I clearly remember him saying he deliberately did this to eliminate the impact of drag from the top-down effect, which is effectively Andrew's process of the replication. So, he's applying this return stack model of a 60-40 portfolio where he's then embedding, 20% of managed futures in there, and his managed futures component has got this top-down process and this bottom-up process to address some of those issues I think that we're talking about.
Yeah, but I do think that on your one comment there, I didn't really understand that, because you said that at least Corey is putting some trend following systems in there. Well, these 20 CTAs purport to trade trend following systems. They are implicitly in there. Maybe Corey is going to do classic trend following. I don't think so. I'm sure he defines what managed futures CTAs do as trend following. Richard.
Now, what Corey's doing, Jerry, is he's actually using a regression process like he does with the markets in the top-down approach, but he's using this regression process for the systematic models that he's integrating into his process. So what it's doing is it's getting the flavour of the systematic process embedded within the replication process, which I tend to like, as opposed to just a method to replicate performance. It's sort of embedding the properties of those systems, the asymmetric properties, letting profits run potentially, however they're doing it. It's embedding those properties through this regression function. So it's more complicated than what Andrew's doing, but I think it is addressing some of those issues.
Oh, I love that. I didn't realize he was trying to replicate the systems as well. I thought he was just coming up with his own systems. That's pretty cool. I like that. That is really, I like that a lot. But I do think, though, that, he'll have the systems that they have, which are not letting profits run and hunting outliers like we do. That's a category that includes 4 people: Moritz, Richard, Jerry, and Mulvaney.
Exactly.
I'm kind of joking, but I mean, go ahead and add some more. I'm willing to expand our little club. And if someone knows other people with a modicum of AUM, then that's great. Now, all the people on Spaces, of course, trading their own money, and of course, you're in the club as well. But so that's a great way of doing it. It's a great, it introduces kind of like another risk of, but it doesn't. It kind of gets away from the lag risk, I guess. And maybe Corey is going to add more markets. That's good. But everything has a little bit of risk, because unless they tell Corey the positions, he's going to be under some sort of same situation of underperforming every now and then. And it would be really interesting for Corey to tell us in the future which one performs better. Ooh, it's very interesting.
Jerry, I noticed you posted one of Andrew's. Andrew did this piece on what is alpha. I noticed you posted it, and I was reading it, and seriously, I was scratching my head. This alpha beta thing, I'm not a big fan of it. I think it's nebulous and very difficult to sort of quantify.
Right. I think it's probably more relevant for people who follow indexes and think that you should fill your portfolio with indexes that have an edge and are going to go up over time, bonds and stocks and gold. Or you have a situation where you are making a judgment call. Hey, I think now precious metals or gold is going to go, commodities are going to go, and I'm not hunting outliers. I want a broad diversification in this particular sector, and it's just so far from what we do. But I guess people use them because they don't do what we do. But obviously not a fan.
It's hard because it's not there's no clear, concrete definition of that. I've heard people talking about alpha in a really loose way. Just what you return in excess from cash, that's alpha for these people. And when you get to the academic papers, the first definition was what comes on average in excess from the stock market index of your favorite stock market index. And you see in the most modern AQR papers, that's the return, the average return that cannot be explained by anything else. And from this perspective, it's not far from that what Andrew is saying. You're saying that, well, take all the risk factors that come in portfolios, and I'm generating return in excess from that comes from the reduction of fees. From the investor perspective, that can be called alpha. So it's, I don't know, it's more of a semantics discussion than anything else.
Moritz, how's Takahi going? Rather than talk about the performance, how's the process of setting it up and getting it all running? Is it quite busy for you?
Yes, it is busy but fun, but all going well. And it took a few days to get limits set up and then all the markets enabled. But at the end of the day, no big hiccups, and actually a good start to this month. So that's good. Fingers crossed. But I'm not sure if the name has come up yet, but I continue to be amazed by Paul Mulvaney and his ability to really outpace everybody else. Like, even in the month where you'd think that, maybe he's going to be flat or only slightly up or maybe even down, at least in the last 12 to 24 months, he's just hitting the ball out of the park better than really anybody else. And it's amazing. Pull my hat to him. It's really, really great performance there.
I must admit, I've been blown away with Paul's results. I think it was 8% this month, or last month. So yeah, I don't think he's had a down month this year, this calendar year, or maybe January he did, but the rest he's just nailed it. It's very impressive.
I don't think that Paul has figured a way out to not have drawdowns. He does have a great way of pressing the trends, not in some sort of predictive way, but in a systematic way. And he deserves to have a hot period, and he's just building up a lot of good returns before a drawdown. And I'm not predicting it because if he has one, I'm going to have one, and then not sure he's going to have one that's going to be even material. But it is quite amazing how he is doing, how consistent he's been. I don't know if he's ever been really this consistent and this having this kind of outperformance, but it really is fun. And I still want to get back into his podcast with Niels and go over that again and really study it. The sound was so bad, and I couldn't pick up on it.
That was with Cavell. Cavell wasn't with Niels, I don't think. I think it was with Cavell.
Yeah, sorry, Cavell. And so I'm waiting for Cavell to put that on YouTube. Hopefully, the YouTube transcript will be a lot will be enough to be able to understand more of what was actually being said. But and I have my own Cavell coming out next month. So. Yeah, Paul, he is just an inspiration, and really showing that if you want to raise money, make a lot of money. If you want to charge healthy fees, make a lot of money. I hope he has a lot of loyal clients.
Do we know how many markets Paul Mulvaney trades? Like, I think Niels assumes it's quite low, but I'm not so sure about that. Do we know?
I think we've seen his presentation, and I don't know, it's not hundreds, but I think it's up there, but it's in the 50s to 100, I would think. I thought the three of us had seen an old presentation of his recently that listed the markets, but I don't remember. Do you remember, Moritz?
50 markets or so. I remember the presentation, which is a dated presentation. I think it's from, I don't know, it's probably 10 years old or so. So the number of markets may have changed. But I also recall a conversation that I had with him, and we spoke about this, and he wasn't trading 100 markets or so. So let's just put it into 50 to 60 or so markets that he's trading, the usual ones. So that's what he's doing. And I think Jerry has made a good point on the like systematically pressing it. I was thinking the same, like, when I run a system, say just a classic breakout system on his markets, and even if I dialed up the risk tremendously, like per trade and percentage of equity, I cannot get to his numbers. So I presume, can only guess, of course, that there's like he has a second and maybe a third system that kicks in and takes another position in the direction of the trend and just kind of like old turtle rules, just go for it. When it put on another unit, or maybe he puts on another 3 units. I don't know, but he just, I think that's what he's doing. Obviously, that is not risk free, but when you have your time in the sun, then these returns are amazing.
Could it be that he's not? Sure, sorry, go on, Josh.
Sure, I asked the all-knowing Google AI, Bard. I asked Bard just now how many markets does Mobility Capital trade, and Bard says over 45. So there you go. It's definitive.
That's right. I'm just looking at the institutional presentation. So in 2013, it was 45 markets traded.
Yeah, could it be that he's not using only futures? He can be on those 45, 50-ish markets, but he's implementing his trades through options or any other thing. So that's why he gets a return profile that's different from what we're expecting when we look at the futures markets.
I would say no options. I don't think he may have even said in the interview that he doesn't use options, but I don't think he uses options. I don't know how he trades. I would say that I would just guess that the reason that he is relatively outperforming, obviously, leverage. He's probably the most leveraged person, CTA, out there that I know about. And then I would also say concentration, or the markets that he trades. The markets that he trades. Maybe he's pretty heavy in indexes because they did pretty well. Although I want to go back to something I said earlier. I think I was wrong about something. I did say that, that the CTAs that lost the most in March, obviously due to the rally in interest rate shorts, they made the most in April, or they did really well in April. But I think I saw some attribution for April, and it did not really come from the interest rates, because they didn't go right back down. It was indices, long indices, and something else I forget. But so that was kind of not a sensical statement that I made. I don't. It's hard to say. My strategy, my philosophy of trading, of adding markets, 300 markets, lots of stocks, lots of small positions, and I classic trend follow, is going to look a lot different than his, even though he's classic trend following as well.
And isn't that the case for all of us? Jerry, thank you for the spaces, because, even though we are bound to have utterly individualistic systems, I mean, Jerry, even if you told me every metric that you use, I still wouldn't replicate. I still wouldn't, wrong word. I still wouldn't have the same results as you. And so it doesn't matter. They're all going to be individual and robust enough to all kind of be valid in the same sandbox.
Well, I think it gets back to what Richard Dennis has said, and what I know Paul Tudor Jones is quoted as saying, which is, I can teach you to paint, but that won't make you a Picasso. And I think that certainly holds true, especially when drawdowns start.
Hey guys, how's everybody? Yes, few comments on the discussion today. I also listened to Andrew's podcast with Tim, and I thought it was interesting, but I didn't really learn much. It was fun in terms of entertainment, but in terms of adding something to my knowledge, not much. And in that debate, if there are two sides, I personally tend to go more towards Tim's argument, and I'm still not convinced that that an index of funds. So this is not an index of securities like S&P 500, like a typical index or index of commodities. This is an index of funds that are each doing their own thing, and that they're each changing what they're doing, or may not changing, or working on improving it, or maybe destroying it, or whatever. So these are active units, active streams of returns, which comprise an index which he's trying to replicate. And I think there's too many layers for this replication to be done consistently. So I could be wrong. And I think there's a reason why this hasn't been done before. And the reason is not computing power. I mean, we've had calculators, we've had spreadsheets. Regression is nothing new. It's more than 100 years old. So I don't understand how now all of a sudden replicating an index, replicating the returns of the 20 best funds in a certain universe or industry, and this could be anything. It became like such a huge invention that's all of a sudden now it's possible. My feelings, not feelings, but my belief is that there's nothing new there. There's nothing new that came up in terms of technology, computing power, access to data, or access to whatever that now makes it possible for something like this to be done. And I think the reason why it wasn't be done because of all the criticisms and risks associated with it. One of them is the lag, but it's not just the lag between getting the data and then once a week executing it. The more important lag is the data that the replicator needs. So the look back that the replicator needs, over which then he can regress. Okay, now I assume that over the look back, let's say 2 weeks or 3 weeks, over a certain window, I'm assuming all these funds have stayed fixed. Assuming that all these 20 funds have had fixed positions over the time for the look back, let's say 3 weeks, what is the portfolio of my 14 markets that I assume to replicate them? What is a fixed portfolio of these 14 markets that can replicate this 3-week series of returns the best? And so now the longer the lag, the more precise you can get the regression. But the longer the lag, the less valid can your assumption be that they will have a fixed position over that time window. So this is a basic fundamental, how should I say, it's almost like Heisenberg principle of uncertainty. There's like a theoretical limit that you're hitting. In order for you to have a long enough look back window to do the regression properly, you have to make an assumption or close enough that all those funds haven't done huge changes over that window. So we were discussing here certain lags between the time that he gets the data and then the time he executes. That's a lag. The lag that I'm describing is a much more dangerous one, and a lag that is going to end up being noise to the replicator, to the extent that these 20 funds have made a lot of changes. Let's say he uses 3 weeks, 15 days, 15 trading days, 3 weeks as a regression window. If these funds have had a huge change in this window, his replicator is going to get confused. His replicator is going to say, hey, for the first 7 days, these 14 member vector replicates it best, but for the other 7 days, there's a completely different 14 member vector that replicates them the best. Well, then two different vectors replicate two different windows in the look back window. But what is a 114 vector that matches the whole series? It doesn't exist. Why? Because there was a huge shift in the lag window, and there, when the replicator tries to replicate that, the regression does the result. It will say, yeah, this is the result. This is the best I can do, but it's not a good fit, and I'm not. And basically, the number of fit is going to say, oh, it's not a good fit. This is the best fit, but it's not a good fit. Now the problem for the replicator is going to be, whoa, why am I not getting a good fit? Is it because I only have 14 markets? Is it because maybe these guys maybe start to put big significant positions outside of my universe of markets? Maybe now they started to trade more soybeans or grains or I don't know, or milk or whatever. So, or there are changes in the position in the look back window, which my replicator gets confused by and I'm not getting a good fit. So this, to me, is the biggest problem with replication. And if I was a retail investor and I wanted to have an exposure to CTAs or trend following or whatever, I would either just go with some well-diversified trend follower or even like one of the ETFs that are just saying, hey, you basically want exposure over different time frames, momentum over, I don't know, half a year, year and a half. This is it. The system is simple. The system is closed, or 4 moving averages or 4 breakouts. I personally would put my money on something simple, transparent like that, rather than this complicated thing trying to replicate the 20 best hedge fund managers. But that's me.
Yeah.
I don't know if anybody has a comment.
Yeah, I was assuming that the replicator is perfect, and even that, even if that's the case, which is definitely not, even if that was the case, the time between his observation and his action is irrelevant. But when you're questioning the quality of the replicator, there definitely he has to make some assumptions on how the CTAs within the index make the change their positions. He needs to do that. He's just running regressions on rolling windows. He cannot replicate anything with a level of confidence that supports what the results he's getting. But therein comes another problem, and that made me think the reason why he possibly uses only 14 markets is exactly that window that he's looking back. He cannot look at a 5-day window with 50 markets. That there's simply no degree of freedom from a statistical point of view to do that. Or he's making really hard assumptions on how markets behave and how the markets behave within the portfolio. But probably the reason why he has 14 markets is because that's the shortest window restriction that he has to respect, where 14 markets fit.
Yes. So that goes along the same principle of. It's not a principle of uncertainty, but yeah, where there's like a theoretical limit as to how well you can do it. And markets last year or whatever have been behaving in a certain way where this thing is not showing. Eventually, there will be movement in the markets and whatever where this will show, and then we will see. But anyway, I'm not wishing this happens. I'm just guessing that this is a very good possibility that it might happen. Now, I also wanted to ask Jerry. Last week we tweeted on vol adjusting. There was like a guy on Twitter that did a back test of doing like a classical trend following portfolio without vol adjusting, and then another same back test, everything the same, but now adjusting for volatility for the positions. And I myself remember doing this maybe 15 years ago or more, just to see. Basically, I was testing different systems. They're nothing similar to what I'm doing right now. But I was just testing like classic control following without vol adjusting, and then classical trend following with vol adjusting, and I also came to similar results like this guy came in the tweet. I don't know if he's here also in the spaces. I'm sorry, I forgot the name. I couldn't go to the tweets, but he apparently did a back test, and he was showing the returns and the maximum return, the drawdown ratio and the Sharpe ratio. And it confirmed a little bit what Jerry was saying, that yes, in order to achieve the same return, I would have to ramp up size a little bit, but the increase of size was not that much, maybe even like 5 or 6% in terms of increase of risk. And the Sharpe and the drawdown ratios were better with vol adjusting, but not by a lot. So from memory, I also seem to have gotten similar results, that classical trend following with and without vol adjusting, the differences were slightly better with vol adjusting. Nothing to write home about, and I can understand why Jerry wouldn't want to include vol adjusting, because why add extra complexity for not much improvement in terms of return to drawdown or Sharpe ratios, especially if Sharpe is not important. But I also wanted to comment when Jerry was just saying now there's like only 4 of us that are doing classical trend following, whereas the rest of them are doing vol adjusting, and then how difficult it would be to replicate somebody who is doing classical trend following and not adjusting for volatility. My question and my belief is that whether you do vol adjust or you don't vol adjust on an exact same system like yours right now, classical trend following, if you use, let's say, the same 100 markets with vol adjusting and without vol adjusting, and you increase slightly the volatility, the risk on the vol adjusting, or even don't, my experience or my memory, I haven't done this test a while, but even from the results that this guy was showing, that these two equity curves wouldn't be that much different if it's done on the same 100 markets, whether you adjust for volatility or not. I think they will be very highly correlated. They will have very similar performance, even though the volatility adjuster will have slightly better Sharpe and drawdown ratios. But it's not like we're talking two completely different systems. If you see one equity curve and then the other, it's not going to be like, wow, this is two completely different systems. So in terms of how difficult it would be to replicate somebody who's not adjusting for volatility, I'm asking Jerry, why do you think it would be so hard to replicate if these 20 were all not adjusting for volatility and doing classical trend following, when an equity curve on a 100 market classical trend following system and on a 100 market vol adjusting, every classical trend following but with vol adjusting, I'm not seeing the two equity curves to be very different, which means those replicating 20 of those equity curves shouldn't be much harder. So what do you say?
Well, I did this research, and I pretty much agree with those conclusions, but I did it as well 15 years ago. One of the things that never, ever crossed our mind, and I think this guy mentions it too, and he's not on, but I would like for him to join us, but because he has really good tweets and he's a really smart guy, but we never, ever considered increasing, the position size when vol slowed down. I think that leads right into what we were saying earlier about Andrew and using 14 markets and relying heavily on his back test, and me saying like, yeah, those 14 worked well in the back test, but that sort of concentration may really be harmful in the future. And I think loading up deep into a trend, I've seen this happen before. August of 2018, Mike, who's on here, he was with me on that day when the Dow opened down 1,000. And prior to that, CTAs were loading up on the S&P because the vol had just sort of come to a crashing halt over the previous few weeks. And I just think things like that don't have to be that much in the back test, but in the future test, it could be really problematic. But to answer your question, I think that the statistics of the equity curve can be similar without the equity curves being similar, in a yearly, over certain periods, right? So last year is a good example of how, especially like in my experience in 2021 and 22. So in 20 and 21, since I'm trading so many markets and some of and the commodities and the stocks, I'm hunting the outlier, unlike the managed futures strategy. Then I'm hitting Tesla. I'm hitting a couple of the grains that other people probably don't even need to trade, because if those grains, rapeseed and canola and palm oil, get too out of control, they're vol controlled and correlation controlled back into being nice boys. Calm down, be nice boys. I'm getting rid of half my position. So my performance in 20 and 21 is kind of dominated by these massive outliers. Are we correlated? We're correlated because having corn and beans is going the same direction as the big outliers in the grains, which, if they even had them, they cut the profit short. Okay. And I don't necessarily mean always that that's a negative. I mean, it is kind of a negative, but I'm not trying to make fun of it. Okay. So then they obviously had making money in some of the indexes, but they didn't make 500 ATRs in Tesla. Okay. So, and I didn't cut my Tesla back. Tesla made 50 ATRs, gave 49 back in the first couple of months of that, after that breakout, and then went to a max of 500 ATRs. So then 2022 comes around, and maybe there was some outliers, let's say in the biggest mover, short rates, but it was a sector move, and that's where managed futures really excels. Everything's going up. All the stocks are going up. We do indexes. All the bonds went down. When you had the big sector move, maybe a couple of those short-term interest rates had outlier type moves. I don't really know. It depends upon how you personally define outliers. But the whole sector moved, and so they did really well. Because we're hunting outliers, don't mean we don't profit when there aren't any, and we just get the sector move. I'm all for the sector move. So I think that's the difference. It's hard to replicate me because I trade 300 markets, 150 stocks, and I'm going to have my own unique outliers, hopefully coming from that group of stocks. Someone else who trades 150 stocks, they're not going to be the same ones. They're going to have their own set of outliers, given that, let's just say they're hunting outliers as well and not getting out due to vol and correlation. So it's just more difficult to be replicated if you're letting those profits run to the max and not scaling them back. Correlations will be similar. The equity stats can be similar, as you've indicated, but you're going to have some differences amongst the years when my 5% of my markets make all of my money, and those 5% could have been some really, really large outliers.
Oh, okay. So yes, I understand, and that makes total sense. My question was more in a hypothetical scenario, and I agree. Your 300 markets will be very hard to replicate with Andrew's 14 markets. So whether you adjust for volatility or not, that's impossible. So, but my question was more. So let's assume we're talking equal universes. So I agree that your diversification into 300 markets and into stocks and whatever is very beneficial, and it's very hard to replicate with just 14 markets that Andrew is trading. But if we stick, let's say, to the 100 futures markets that most macro or CTAs or discretionary traders trade, that everybody knows for 30 years, so nothing exotic, no micro caps, no I don't know, French fry stocks or whatever. So let's say if we stick with a fixed universe of 100, if we stick with which I think, if we look at the index itself, the biggest funds have to stick to the most liquid markets in the world. And to the extent that they diversify into something that's obscure or more exotic, there's only enough liquidity you can put in it, and the returns from it are going to be insignificant. So if these 20 funds are big, they have to be big to be into the index because they're the most successful ones, and they mostly trade the 100 markets that everybody else trades. Whether they adjust for, my point is whether they adjust for volatility or not, it's not making a big difference. It's not making a big difference. So we can have the index of 20 funds, they all adjust for volatility, or we can have the 20 funds trading the same 100 markets and none of them adjust for volatility. I say that the two equity curves and the performance of the index are going to be barely distinguishable, almost indistinguishable. What do you say?
I mean, you got to admit that that's likely to be that's more likely to be true if you look at a lot of years. But you can't deny the fact that if there's going to be times where the classic trend follower who lets the profits run and doesn't scale back makes a lot more money on those outliers, and the the sacrifice to the vol gods causes them to make a lot less on those individual trades. And so that can happen, and it probably does happen. And then in other years, using vol to exit versus trend is going to outperform. And, they used to be very consistent that this was risk reduction. Now, when I read the managed futures guys or maybe listen on Spaces, it's like, no, it's both. We take profits. We don't want to give it back. Oh, that was very prominent in the CTA series that Niels did. We just don't want to give back that profit. So, but when you run that in the computer and you essentially ask the computer, it's like, okay, tell me, what's a better signal to capture these trends and to make money? Is it waiting for the trend signal, or in some sort of crazy way, does the vol signal is a better signal to liquidate than the trend signal? And every bit of research I've ever seen says no, it's not a better signal. You can't have it both. You can't have an increased Sharp and take my money. I'll take the money with a lower Sharp. I'm understand that you get the less money with the higher Sharp, but more AUM. And so that's the way it usually works. The back test is not going to say, hey, what's better than the breakout? Vol. That's nuts. Of course it's not. And the computer verifies that. It's not. But when you're hunting outliers and that 5% of the trades can dominate the portfolio, of course you can have vastly different performance over a year or two period, positive or negative, because I'm making a ton more than the vol managers, or I gave back all of the profit in some trades and in some years because I didn't move my stop up. And the only way to ensure not giving back a lot of that profit is to have a different kind of an exit versus a trend exit. And I don't think you can discount, I don't agree at all of your first statement you made after my statement, which is vol management or not vol management. No, it's all about vol management. His ability to replicate. Those CTAs trade 100 markets each. So you can't sort of just dismiss this idea. Well, if you trade 300, he can't replicate. Well, show me your scientific research that says, well, 100's okay, but 300 produces giggles. No, it should be difficult for 100. He's got 14, but it's not difficult for 100 because they vol manage. It's all about the vol manage. It's combined with it's 20 of them, and so the vol manage because they don't have 5% of their trades responsible for all the profit. They're not hunting outliers. The sector moves are what's responsible for their profits.
Okay. I mean, I understand what you're saying, and I think, and I'm also, again, I have to say, I haven't done this research recently. This is from maybe 15 years ago. The two equity curves are not only similar, like over the long period of time. Even when you say one can have a good year, the other one doesn't have a good year. I think they're basically, even year to year performance is pretty much matching similar. Maybe one outperforms a little bit, one underperforms a little bit, and they kind of go back and forth. But basically, they were very highly correlated. They look the same. They pretty much look the same. And so these big differences that you're talking about on a trade by trade and on an anecdotal level, because if you think about it, I mean, even if you vol adjust, 99% of the trades, even when you vol adjust, so let's say you're going for an outlier and somebody adjusts for volatility, I don't know, volatility doubles, you keep the size fixed, that guy cuts, the vol adjuster cuts size to half, so he takes profits from half. Volatility triples, he's still in the trade. He's out 2/3 of the position. He only has 1/3 of the position on. So yes, you're making more money. But how many situations are there enough instances where such huge outliers happen, and to such an extent, and over big enough number of markets to show a significant difference in performance for the whole portfolio? Because if this is an outlier and if only happens in one market, that's one market out of 100. So yes, on one market, you kept your size fixed, you kept your, I don't know, 9 contracts going, and whereas this guy cut down to 6, and then he cut it down to 3, he took profits and whatever. And on that one market, yes, you made more money than he did, but that's one market out of 100. And because it's one market, and not only the rest of the 99, your performance is not going to be that much different. But if this happens often enough for it to make a difference, then we're talking about sector moves. Then if it happens all across the portfolio, they're not outliers. That means they happen often enough to make a significant difference in the performance between the two strategies, and then they happen. So it's like you can't have your cake and eat it too. If it's an outlier, it's rare. If it's rare, it's just 1 in 100. And if it's 1 in 100, it's not going to make a huge difference in the overall portfolio. There are other markets in that portfolio where in this one market you made more money, but the guy who cut size for volatility in 4 other markets, he saved more money because he got out where you reverted and you lost a lot of the money. So at the same time, the extra money...
That just doesn't show up in the back test, that it's worth cutting those positions back. You make less money. This may not be obvious to you, but if you want to determine when to get out of a trend, the computer says look at trend, don't look at vol. But that's fine, because that's true, but doesn't mean you won't still look at vol. But you want both. You want, no, it's true that it's just as good or better to get out on vol, and I'm going to have lower vol. And I'm saying, no, you're going to have lower vol. The computer says you just make less money. And it's not one trade. It's 5% of the trades. So you've got about 5% to 10% of the trades on average with these outlier moves. And I would say that, another thing I don't understand why I said this, but is that I would say that when you do get these outlier moves in these individual markets and you don't cut them back, I would say that it's very rare that, not 1%, but it's very rare that you don't get an increase, and maybe even a tremendous increase in volatility. So almost on every big outlier, you're going to cut that back. It's not 1 out of 4. It's every single one almost. I haven't done that number, but it's in the 90s where your vol is going to increase from entry for a long-term outlier trend.
But hey, there's a distinction here that I think it's worth mentioning. An outlier move for the price of a security, that can be rare. That can be, I don't know, 1%, 5%, whatever you want to, however you want to define it. But from the portfolio perspective, that can be a much larger number than that. And the trend following systems do exactly that. They look at the 1% price moves and get all of them, and look at the other 99% of price moves and do not get all of them. So from the portfolio perspective, it's 10, 20, 30% of the trades that are what can be called an outlier from the naive eye that looks at the price charts.
All right, I get it, guys. Yeah, I don't have much to say about this.
Well, I'd like to hear from Richard and Alp. They've been awfully quiet about their tweets concerning trading multiple systems and seeing a big benefit in performance from trading multiple systems, which I don't think I fully understood the concept that Richard was talking about. But yeah, once again, I don't get much benefit in overall performance increase due to trading multiple derivations of my system, because they're all kind of the same breakout with just different parameters, look back periods. So they tend to diversify performance a bit, but not really increase it. Now, and I'm not looking at Sharp, of course. But there was an interesting, if not interested in that topic, then there was another interesting topic I saw this week, and from Quantica, and they put out a paper which I don't know if I've tweeted about this yet, and it is the paper concerning the optimal look-back period. And of course, their optimal look-back period is going to be measured by Sharp. And so I got this, and it's 1 quarter. It's a quarter, 90 days, 3 times 20. Well, that's my interpretation, 90 days. So 90-day look back is optimal. And then their conclusion was, well, one of them was that that's what most CTAs are using, the big ones, okay, the smart ones. And so my look back is longer term than 90 days. My shortest term system is longer term than that. And my longest term system, whoa, don't even go there, if 90 is your optimal. Okay, so that's what they were saying. And then I had a brief interaction with one of the people who works at Quantita on an email, because we're friends. And he said he loved this paper. And I said, my research indicates that a much longer look back is optimal. But I don't use Sharp, and I just use kind of a betting way of looking at risk. You risk $1, you make 3 on average. You risk $1, you make 3. And so I have this binary approach of entry, exit, stop loss, risk 1, make 3. I don't care what happens in between the entry and the exit. I close my eyes to that volatility. That's not risk. I just do it kind of like a betting thing. And so if you look at it that way and you don't look at vol, then I think the optimal look back is longer if you redefine what risk is, essentially, I guess. So I said that could be a good subject for your next paper, which I'm sure he's like, what the hell's wrong with you? I'm not going to write a stupid paper about that. But anyways, I don't know if anybody has any comments on that paper or that concept.
Jerry, I didn't hear what the paper was this. Can you repeat it?
This was a paper from Quantica. That's how I pronounce it. Richard pronounces it Quantica. Yeah, I like that better. But, Aussie, American, what are you going to do with this language?
So how would I find it? What's the author and whatever?
I will send it to you. And I will post some tweets about it. I think I already did, though. I think I might have already done that. But
I think you did, Jerry. The Quantica paper's on your Twitter feed.
Yeah, right.
How long ago? How long ago shall I look for?
This week. This week.
Yeah.
Okay. Thanks, guys.
Yeah. So, what did you think of the paper, Richard?
Yeah. Well, it sort of confirms what my process picks up. So, with this ensemble of systems that I've talked about before, I'd like to pick up something, Jerry, you mentioned last week where you said, I don't agree with you on sample size, because the way my process goes is that each one of the systems that I use for my portfolio has to go through this intense robustness phase where they're looking over 30 years of history for the market that they'll be trading on, plus they've got to pass all of the other markets or the majority of the markets in the portfolio, which builds a massive sample size for each of the individual systems that I deploy. And roundabouts there, they tend to be fairly equivalent in number, and they all tend to be falling on the medium to long term. So from my range sort of models sort of goes from about 50 out to 300. I think Quantica, they were pulling in about 80, I think they were talking, or 100 they're putting for their optimal. But I suppose, what I think they were getting at is that the optimal look back was what they would refer to as their medium-term horizon. Probably not the long-term horizon that some of my models do, but the large proportion of my models do sort of fit within that medium-term look back. And it's not because I haven't tested the shorter term timeframes. I do. My optimization process looks at a schemata going from, 25 up to 500, and they all tend to fall around that level once they pass this extensive robustness phase where sample size is imperative for all of my models. Now, I'm using sample size because they're looking at the risk management aspects of the portfolio. They're not looking at the outliers. I've talked about that previously. So from a risk management perspective, sample size is incredibly important for me because it's telling me the range of the linear adverse moves that I want to cap. I've got no sort of ability through sample size of outliers because each one of them is fairly unique in nature. They're often very chaotic. I can't really grasp a statistical quantitative tool to sort of define how I should let these profits run. So I just let them run with maximum degrees of freedom with loose pants. So all of my models also are loose pants. And the process that I use sort of falls at around, 3 ATR, 4 ATR, up to about 7 or 8 ATR for all of my different ensemble of models. So look, when we're looking at the things that we've discussed on spaces, they apply to all my models. The only thing that differs from my approach, maybe to your approach, Jerry, is that they're not all classic breakout models. And what I've found is that I do use what I call a core representation of breakout models in my ensemble. So I must have at least 4 to 5 core breakout systems using a Donchian breakout technique, similar probably to yours, Jerry, as far as the entry. But what those core models, they're designed to ensure that I never miss an outlier. But what I do find is that because I'm waiting for this higher high or lower low on my breakout models, the way it's structured to break through that Donchian, either up or down, that they tend to do it with accelerating volatility. And what I find is that my position size on those models, so each of my models apply an equal dollar risk, but the ATR is used to determine the position size with that equal dollar risk. What I'm finding is with the breakout models, the position size tends to be a bit lower than some of the other models, so these supplementary models I do. So the only difference between what I do and what you do, Jerry, is that because I'm not using just a standard core representation of breakout models, I find that if I did just use that standard core representation of breakout models, I'd find that my performance would be clustered, significantly clustered. You know, when we've got good trends, they're clustered and they're fairly highly correlated, those breakout models. So these supplementary models are specifically designed to break down that level of correlation for a single market. The different techniques I use with the supplementary models effectively are focusing on different entries. And also because each system is independent to each other. So it's just like the way we treat all of our systems. So they're treated on an individual basis, not on a collective basis. So each individual system is independent. I find that because I'm using these alternate models, my entries are different. Also, my exits are different. So I'm not getting this clustering effect. And what I am finding, though, is that some of these supplementary models are able to capture significant outliers in their trade performance. So, when I'm using these breakout models, I might find on average the major outliers that I'm getting on my models might be 25 to 30 R, but some of these supplementary models pull out, outliers of 100 R or 110 R, which is very big in my world where I'm using R, which is the initial position to its stop is defined as a distance R, and then I use dependent on how the trade works out. 100 R means that I'm 100 times greater than my initial stop position on that particular trade. So even though I might miss some outliers, those 100 R or 90 R or 70 R, they pay for a lot of those missed opportunities because I'm not using a breakout model. So with all of this process, I'm finding that it's doing a couple of things. It's reducing the level of correlation for a single market. So what this means is that I can trade Brent and I can trade crude. And because of the different entries of my different systems, I don't have to worry nearly so much about the correlated nature between Brent and crude. And I'm getting a significant different correlation structure between Brent and crude, which allows me to trade both of them quite harmoniously without finding that they're over-correlated. So this ensemble approach I'm finding allows me, because, I might go up to 10 different systems. I'm always recognizing that market diversification is the optimal form of diversification, but by including this ensemble of, say, 10 systems, I can actually spread my market diversification wider than if I was trading, say, simple breakout models. I might be able to only trade 80 markets without finding that, they're all starting to become fairly highly correlated. But if I'm using an ensemble, I might be able to go up to 150, 200 markets and find that, the level of uncorrelated relationships with the return streams is allowing me to get away with that with much wider market diversification. So I think, what I'm finding is I'm finding the same benefits in my system diversification as I am in my market diversification. And I don't see where there's a problem with that because, as we all know, with these outliers, which are fairly chaotic in nature, if you imagine an ensemble of models attacking that outlier, we talk about loose pants, but all of the individual models have loose pants, but collectively, that ensemble of models means that it's got the loosest pants of all because the collective is actually targeting all of these possible variable trajectories that outlier might take, as opposed to, say, a breakout model, which is more restricted in its definition of how it's calculating the trend. So there are these benefits, I think, that are coming into my process by just at least considering maybe going a bit wider out with the level of system diversification and really focusing on unique systems, not necessarily the same system, to get some of these benefits coming in.
That's why Richard is the professor. So that's brilliant stuff. That's good. I love all that. Now, I did write down some questions, comments. First of all, I left out I have to continue to say this because I forgot to make this point when Absolute and I were talking about vol management. And that is, no matter what we say, and I've said this many times, no matter what I say, everything I just said, it's all none of it is as important as I really don't like vol management because of sample size. And so that's my statement. That's what I live by. That's the ultimate reason I wouldn't do it. If the performance was better, materially better by vol management, I still wouldn't do it. So I got on his playing field. I did a good job of arguing about it. I think he got frustrated with us because we're not as smart as he is, but that's not where I want to be. I want to be on my battleground. My field is I'm going to pay attention to this sample size. And by definition, it's not a question of whether the sample size is impacted negatively by vol management. It's just how much is it impacted? And I think too much. Now, I do want to comment on what Richard said about sample size. So I'm trying to interpret, kind of like summarize sometimes what you say, and I kind of get it wrong. But so what I wanted to say about this is that we've had many discussions, and I think we do have a slight difference on using sample size to validate our strategy. And so sample size is you include all the trades, and I think you've said, well, I don't really feel comfortable including those outlier trades in the sample size. And so you have this small 5 or 10% of the trades that make all the money, so I don't really feel comfortable including them in the sample size. Well, that blows up, turtle trading.
No, that's not what I was saying, but keep going.
Okay. I'll keep going. And so I think that my interpretation of what you said is that, look, I do these back tests, and I do them to and I update them frequently, once a year or whatever. And so in this process, what I'm trying to do is stay out of the normal distribution. I'm trying to get to where the outliers reside. So in my world, that would be like, I'm not buying today, I'm buying at the 100-day high because that is unusual. If it gets to the 100-day high, now maybe we're approaching a different regime in a different place. That's where I want to be. And I'm kind of using these loose pants parameters and look backs to keep me involved in this, but I'm not really like saying, hey, look at this back test with this sample size. That's what I can expect in the future. I think which is what I say, which I think what you're saying is, well, I'm not comfortable predicting the future in this way. I don't really like this thinking that my robustness is hinged to this sample size. Certainly, I don't think the future is hinged to it. And so I'm more like putting myself in an educated position where I'm only taking these trades when it's something unusual is happening. And I think, okay, so correct me on all of that.
No, so I am taking sample size into account with all of my trades. So all of my trades, of course, include those that have achieved outliers. But what I'm doing is each of those trades, I'm viewing a single trade as a component of two things. One is there any positive upside on that trade, and is there any risk to that trade? So when I'm talking about a trade, I'm talking about a return stream. So I'm looking at all my return streams and I'm saying, all right, let's look at the adverse risk of those return streams, and then and let's look at some of those outliers of those return streams. So in a single return stream, you've got both components, possibly an outlier, maybe 3 or 4 outliers in that return stream, but most of the impact of that return stream is from losses or small wins. So the reason I do take a lot of heed in relation to sample size is that because I'm wanting to target the tail region of the distribution of returns, I want to get a limit in place where I can define how loose a pants should I have for my models and when should I participate in those trades. So I'm using this significant trade sample that I've got to define what I'm calling the boundary of the Gaussian envelope. I'm looking at the boundary of the Gaussian envelope where it starts to become more tail-like in its properties. Now, when the tails themselves are the things that are contributing to these outliers, and these tails are very chaotic in nature. So the positive benefits of each individual return stream, I'm just adopting no profit targets. And if you can imagine, the only constraints in my systems are where to put the stop and where to put the trailing stop. Now, what the stop and the trailing stop is doing is it's looking at the Gaussian envelope saying, I want to give maximum freedom for this trade to move with loose pants, but where should those things be defined? And I need sample size for that because in the Gaussian distribution, you can use sample size to basically quantitatively define where that limit is. The only thing is you cannot use quantitative statistics to say how far your profits are going to be because you're in the tail region and you can get, huge profits. Any individual market can offer huge potential. That's why we always say each market and each system has equal expectation, at least in my world, because with these outliers that I'm catching, I don't know what they potentially can give. Some of them could be huge. And even in highly correlated markets, one market could give me a huge outlier and the other market that might be highly correlated to it doesn't. So this is why I'm saying I must treat each market and each system I deploy as having equal expectation because I've got no idea what the future's going to be. So I don't use my backtest to say what the future's going to be, but I do use my backtest to say, where should I put my stop? Where should I put my trailing stop? Because I want my losses to be linear in nature to allow for maximum asymmetry to give these outliers maximum opportunity to be non-linear in nature.
Okay, very good. Now, you just made me think of something else, which is volatility management. I know you're against this, so am I. And that is, it's optimized from the history of these outliers, and we're sort of saying, "Whoa, I don't like that. What about those outliers? What if they're a lot bigger in the future? What if things are so much better in the future?" That's one of the reasons that the CTAs from Europe in the 2000s started doing so well with their vol management is that we had periods where the outliers were not as present. The less outliers you have, the more that sort of thing is going to work. So many trades I remember having nice profits, giving it all back, and having relative underperformance. Okay, now I wanted to ask Richard if you're willing to talk about it. So these supplementary systems, the non-breakouts. So on the breakouts, I agree with you. The breakouts are very correlated. So I have all these different systems, but sometimes they're buying on the same day. They're entering on the same day, and then they could be exiting similar places. But they do have a tendency to stay in the trades a long time because I have a long look back period. Which another thing that helps me is that they have it. The longer you can stay in a trade, the more you're given these smallish trades more opportunity to turn into an outlier. So you could actually create an outlier if you have loose pants and if you don't get out and have to use a different ATR. I think my ATR in Tesla was 87 cents. Now, if I'd have gotten out of Tesla after that big drawdown or during it, I would have gotten back in at the highs at God knows what the ATR was, but it would never have produced anything close to a 500 ATR profit. And so the mere fact that I stayed in that and didn't get out and was willing to risk the entire 50 ATR profit, that kept that original ATR that was ridiculously low, and I didn't vol manage because it would have scaled back the position as well, because that ATR is so sacrosanct, which I don't think it is. It's not. It just tries to normalize losses. So, okay, that's my opinion. So now I'm very intrigued that maybe these supplemental systems also have a way to even improve upon the breakout systems as relates to this ATR, and they work really well because they have this ability or characteristic of targeting or having a lower ATR at entry, which may be too much proprietary nosiness on my part.
Well, some of them do. Like I use this Davis congestion box. So, normally when we're talking about trends, we're going in on, we're looking at a medium term look back with a Donchian channel, and we're entering when on the higher high or the lower low. But the Davis congestion box, that can actually operate at any point during a trend where you get a congestion channel over an extended period, and then you can get a snapping sort of breakout from your congestion box. It doesn't have to occur at the highest high. It doesn't have to occur at the lowest low. It can occur during the trend where there might be a congestion period there. Now, the congestion box, that Davis box, that sometimes can get fantastic position size, but also gets a hell of a lot of whipsaws, but sometimes it can nail very, very good position size. And what I am doing for all of my systems, supplemental or core, I do use the standard ATR-based initial stop and ATR-based trail that I use, that chandelier exit. So common to all of them is that technique of stop and trail, but the entry itself, I can find during a congestion period, we can get very low ATR over that congestion period, getting you some really good position size on it, and then it explodes from there in the direction of that primary trend. So, other things might be a regression line trader. The principle of that is it's looking for a breakout out of a regression band that's sort of using a moving window of around, a look back of, say, 100 periods or 150 periods, and the channel sort of moves along the regression channel, and it's looking for a breakout out of there. So that can sometimes, that can... The key thing about this is the entries inevitably are different to what the breakout entries are. So I'm finding that these different forms of systems are definitely far less correlated on entry than, say, or one type of system like breakout or something like that. So it is getting that diversification of entry. And, because sort of they've all sort of gone through this robust phase of testing, their loose pants models, I also find that their exits are different as well when you combine all of these things together. So that's what I'm finding with this approach. I'm pretty happy with it, but Jerry, I don't think really, I think the theory behind exactly what you say is still applicable, just with perhaps considering alternate systems to supplement your core breakout.
I like that. I remember back in the day, originally we were sort of taught you cannot miss a trade. And I think you mentioned that these supplementary systems, they may miss a trade, but it's kind of made up by the trades being so large. And I remember them telling us, like, no, you just never miss a trade. That's the cardinal sin, to put that trade on trend followers. And if we had a filter, it would just be, okay, buy the 40-day breakout with the filter, but if it gets to the 60-day breakout, you've got to put it on. And I remember them loosening up on that later and saying, well, yeah, use this filter, and then it doesn't seem to make a difference. This was his big quote. It doesn't seem to matter if you kind of miss that trade. And I was like, oh, God, no, I'm not going to do that. So I was like like being more strict, than they were. And I sort of like pick and chose what I wanted to believe. The first pronouncements I tended to favor over maybe latter pronouncements. And I do think, though, that, and we can pick up on this next week, but I do think that I get away with some of this highly correlated systems because I trade 300 markets. And so I don't have a tendency to put on trades in similar markets on the same days. It's just that my individual entries in the market, in a market itself, might be somewhat more similar, but it does, some of that negative diversification does get a bit washed away by trading so many markets. All right, it's been great. I'm sorry I got to run. Man, this was a very good one. I'm really disappointed in you, Alp. You didn't speak this week. I need to hear from you every week. All right, everybody, take care. Thank you very much. See you next week.